Hello everyone, welcome to COMM 217 tutorials. Today we're going to be solving the multiple choice questions from the winter 2015 final exam. So let's get right into it. It's 18 marks, 30 minutes. So question 1. This question tests your ability to be able to compute what free cash flow is. So they give you some values, and you have to determine what the free cash flow is. So let's just remind ourselves of what the free cash flow is. Free cash flow is equal to cash flows overall minus your dividends minus your capital expenditures. Okay, so the company reported 85,000 from operating activities. So it's 85,000, 18,000 for investing, cash flow from investing, and they generated another 49 from financing. Okay, so this is their total cash flows. From this, we're going to take away $22,000 in dividends, and we're going to take away $35,000 for the capital expenditures. So that gives me 95,000. So the correct answer is A. 2. Which of the following events decrease shareholders' equity? Okay. Well, let's go through these. And I think the way I'm going to approach this question is to actually think about the kind of journal entries that are involved with each one of these transactions and see if they do result in a decrease in shareholders' equity. So payment of a previously declared cash dividend, let's see what that would look like. We would do something like this: dividend payable, remove that off our books, and credit cash. Now, does this decrease shareholders' equity? No. Declaration of a 5% stock dividend. What is the entry for that? Well, if you want to pay a stock dividend, you debit retained earnings and you credit common shares for the same amount. Okay? It doesn't reduce shareholders' equity. It changes the composition, but there's no net decrease overall, because remember, shareholders' equity is equal to common shares plus preferred shares if you have some, plus retained earnings. Okay, so this does not decrease it. Declaration of a cash dividend for preferred shares. What is the entry we would make for this? We would either debit dividends or retained earnings, and we would credit dividend payable. Okay, so yes, this would decrease shareholders' equity, because you can see there's a debit right here to dividends or retained earnings, okay, which is in effect a decrease to shareholders' equity. Declaration of 2-for-1 stock split, there's no entry here. Okay, the only effect, the effect of a stock split is that it reduces the market value of the shares. Okay, so the correct answer to this would be C. Question 3, cash receipts from customers are greater than sales revenues when there is a... Okay, so they're asking us to see what the effect is on an account, either cost of sales or trade receivables, when cash receipts are greater than sales revenues. Okay, so let's look at our accounts receivable. Okay, when cash receipts, so let's just spend a bit of time looking at this account. So in terms of debits and credits, okay, any debits to this account are sales, right? Credit sales. So if you make a credit sale for 100, you'll debit receivables. Yes, or you'll debit receivables, yes, and you'll credit sales. And when you collect on your receivables, you debit cash and you credit receivables. So any credits to receivables are cash collections. Okay, so let's get back to the question. Cash receipts from customers are greater than sales revenues. Okay, so let's just plug in some numbers. Okay, I'm going to assume that my cash receipts are 100,000. And my credit sales are less because my cash receipts are greater than my sales revenue. So let's call my sales 80,000. Okay, and let's assume I had an opening balance of 200,000. Okay, so again, let's just recap. You had an opening balance in your receivables of 200,000. Your cash receipts were greater than your credit sales. Okay, what is your ending balance? You started off with 200, you added 80, and you collected 100. So your closing balance is 180. Okay, so let's see if this situation is reflected in any one of these answers. So what happens is your receivables has gone down. It's gone from 200,000 to 180. So the correct answer here is B. Okay, whether you let's look at cost of sales. Whether you collect more cash than your what you've sold doesn't affect your cost of sales at all. Okay, so the only accounts that these two items will affect is your receivables. Okay, so the correct answer is B. Okay, so 4, we're asked to do more or less the same thing, but with trade payables. Okay, so they're asking us how much cash was paid to suppliers in 20B. So the easiest way to go about this is to use T accounts and to understand or to remember what goes on in an accounts payable account, which is a liability. So we have debits and credits. Okay, any debits to an accounts payable is a payment, right? Payment to suppliers. Any credits to accounts payable are purchases. Okay, so the company recorded net purchases of 20.3 billion. Okay, so let's put that here, 20.3. In 20A, for 20B, in 20A, the ending trade payables was 1.2 billion. That means the opening balance was 1.2 billion. And in 20B, it was 1.6 billion. So they're telling you that the closing balance was 1.6 billion. Okay? So if you can figure out where these numbers should go, and they should all go on these two should go on the credit side, you know the closing balance is 1.6, and you simply solve for the payments, the payment to suppliers. So 1.2 plus 20.3 minus X is equal to your closing balance. So your payment to your suppliers is simply 19.9 billion. Okay, so the answer to that is B. A rising balance in inventory account. Okay, it means you've got more inventory than you need, and a falling inventory turnover ratio implies that the inventory buildup is happening because it's simply A. Which of the following is true? Okay, factory overhead consists of manufacturing costs other than direct materials and direct labor. So this is sort of a COMM 305 question or material, and so A is correct. Let's just look at the other ones just to make sure that these are not true. NRV, net realizable value, is the expected sales price plus selling costs. Okay, this is false. Okay, it's expected selling price less selling costs, if anything. FIFO reserve is a contra sales account. This is absolutely not true. It has to do with inventory. Purchase discounts increase sales revenue to arrive at net sales. No, false. Okay, purchase discounts, they decrease your net purchases. Okay, so what you'll have are purchases minus purchase discounts. Okay, so that's why A is the correct answer. Question number 7 has to do with payroll type transactions. Okay, so here we've got a company that pays out $130,500 to its employees as net pay, income tax $19,000, Canada pension plan $5,000. Okay, and as you should know, the employer, okay, in many cases, will match the employee's contribution to the Canada pension plan. Okay, so we want to find out the total wage expense to the company. Okay, so in order to make this a bit easier, I'm going to do it in 2 steps. Okay, I'm going to calculate the employee's portion, and then I'm going to come back and compute the effect of this additional $5,000 that is the company's portion. Okay, so we know that $130,000 was paid out to the employees as net pay, which means this is the cash that was paid out. So in one, I can start building up my journal entry, and I know that we paid out $130,500. So I'm looking for my salary expense. The income tax withholdings were $19,000, so I would have withheld this from the salary, and it creates a liability for the organization until it remits that $19,000 to the government. So we have, let's call it deductions payable. Okay, this is deductions at source payable or taxes payable. Okay, this is something, regardless of what you call it, what it is a money that's withheld from the employee's salary and remitted to the government. So the organization acts as a tax collector in one sense. So we owe the government $19,000 for this, and this is for the income taxes. We also have CPP deducted from the employee's salary. This is the employee's contribution. So the gross amount for this particular part of the answer, okay, if you just add all these up, all your credits have to equal to your debit. So it must mean that the gross salary for this part of the question was $154,500. And that's this. But it's not correct because we also have to take into account that the employer also has to match the CPP contribution. So the entry we would have made to account for this $5,000 matching is CPP payable. This is, again, the employer's contribution, and the debit would have been to salary expense. Okay, so the employer's expense is $154,000, okay, plus the additional contribution of $5,000 for the matching CPP. So the correct answer to this is, in fact, $154,500 plus 5, so $159,500. Okay, so the next one. Okay, so this question is simply test your ability to understand how gross margin is computed, how we arrive at that number on this statement of earnings. Okay, so you just simply have to create a little income statement. So let's go. We have sales, $200,000. So we're going to do sales, $200,000. Discounts, sales discounts, $4,000. So this is net sales, $196,000. So I've got this, I've got this. So then it's my cost of goods sold, okay? And I know that to compute that, I need my opening inventory, which is $10,000. I need my purchases, which is $140,000. And the sum of these two numbers gives you the cost of goods available for sale. Cost of goods available for sale. So you have $150,000. Okay. And if you, let's just continue this here, $150,000. And if you take away your ending inventory, which means the goods that you did not sell, ending inventory in this case was $20,000. So your cost of goods sold is equal to 130. Okay. Gross margin is equal to sales minus cost of goods sold. In this case, it's 196 minus 130. So your gross margin in this case is 66,000. 9 has to do with contingent liabilities. Okay, so here we have, when there's a present obligation that probably requires payment. Okay, so these are the conditions. When it probably requires payment and the amount of liability can be reliably estimated, the company should, in this case, record the liability and the estimated amount on its balance sheet. So that is number 3, and you can read about that in your book. When the effective interest method of amortization is used, what happens to the total amount of discount or premium amortized as the bond moves to maturity? Okay, so this is a fairly tricky question, okay? And the key thing is to zero in on this word total. Okay, so what happens to the total amount? So let's say we have year 1, year 2. Okay, and let's just use any numbers. Let's say 5,000 and 4,000. Okay, as the bond moves towards maturity, okay, every year the total is 5K. Here the total is 9K, and you know, even if we do 3,000, this will be 12K. So the correct answer is, as we move towards maturity, the total amount of the discount or the premium increases. So I'm looking at this number here. So the correct answer is C. It increases each period. Okay, not the yearly amount. Okay, that is the tricky part about this question. So the total amount is different from the yearly amount. Okay, and depending on the method you use, the annual amount could be more or less, but in total, it's always growing. Question 11, one difference between the double declining and the straight line method is that the double declining balance, A, causes the carrying amount to drop below residual value. This is false. Okay, you cannot depreciate an asset below its residual value. So this is false. The double declining balance method doesn't consider the useful life of the asset. That's also false. Cannot be used for tax purposes. That's false. So the last one is D. Okay, and it uses the carrying amount instead of the depreciable cost in the calculation. And we all know that double declining balance, its carrying value times the rate. Okay, so it uses the carrying amount, not the depreciable value. The last question, number 12, okay, is a long-term asset question. Okay, so here they buy land and building for $4 million, including all fees related to acquisition. The land is appraised at 2.7 and the building at 2.1. The building is then renovated for a cost of $750. Okay, so what you've got to realize is that this is a basket purchase and you need to split it up between land and building based on the fair market value. Okay, so here we're going to do it right here. So we spent $4 million. Some of that is for land and some of that is for building. Okay, the land has a fair market value of 27 and the building 21 million, so 4.8. Okay, but because it's the historical cost principle, okay, we can't book the building at 2.1 million. We have to figure out what portion of this 4 million should be allocated to the building, and we're going to use the relative market value. So if you take this 2100 over 4,800 or 2.1 million over 4.8 million, multiply this by 4 million, that will give us a cost for the building of 1.75. So of this 4 million, okay, 1.75 is being allocated to the building. And to that, we will add these costs of 750 because these are exclusively building costs. Okay, so the total cost of the building will be $2.5 million. Okay, so this is the amount that's capitalized as an asset. Okay, so the answer is B, 2.5 million. Okay, that's it for today. Thanks a lot.